Hello and welcome back to the channel. The stock market keeps hitting new records and everyone seems to be celebrating. But beneath the surface, something doesn't quite feel right. Stock valuations are stretched thin, the economy is losing steam, and yet the S&P 500 continues its relentless climb. It raises a critical question. Are we witnessing another bubble or something far more calculated? Let's start with the basics. The S&P 500 is currently trading at a price-to-earnings ratio of 28. That's significantly above its historical average. Meanwhile, a powerful macroeconomic gauge known as the Buffett indicator, which compares the total value of the stock market to the gross domestic product, GDP, is soaring above 200%. For context, the long-term average sits closer to 100%. This means the market is valued at more than double the economic output of the country. The last time it reached levels anywhere close to this, the dot-com crash soon followed. Now consider the actions of Warren Buffett himself, arguably the most respected value investor in history. He's currently holding close to $350 billion in cash, the highest in Berkshire Hathaway's history. That's not because he can't find good companies. It's because he's choosing not to deploy that cash right now. Buffett has made it clear over the years, when markets detach from reality, he steps back and waits. And yet, while fundamentals weaken, the market continues to levitate. Earnings are softening. Consumer demand is moderating. Lending is tightening. Despite all this, stock prices keep moving higher. Why? Let's unpack this through four critical forces shaping this market, and why they may not be accidental. These forces suggest we may not just be living in a bubble. We may be watching a strategically engineered one. Factor 1. Valuations are detached from economic reality. First, consider pure valuation. The Buffett indicator mentioned earlier is one of the clearest measures of whether stocks are overvalued or not. It's simple. Divide the total market capitalization of U.S. publicly traded companies by the GDP. When the ratio is near 100%, markets are considered fairly valued. When it stretches far beyond that, as it has now, it means investors are paying huge premiums relative to what the economy is actually producing. Right now, that ratio is not just elevated, it's at historic highs, over 200%. For comparison, the ratio was around 160% during the 2000 dot-com crash and peaked at a similar level in 2021, right before the tech correction. Today, we are far beyond either of those moments. Warren Buffett has consistently warned about markets where investors abandon fundamentals and chase stories. To illustrate it simply, imagine walking into a store and seeing a $10 item marked up to $30, yet still deciding it's a deal just because others are buying it. That kind of thinking eventually breaks. Buffett often says, the market is a voting machine in the short term, but a weighing machine in the long term. That means emotion can drive prices for a while, but over time, reality always wins. Right now, that weighing machine is flashing danger, and Buffett is responding, not by buying, but by waiting. Factor 2. Flooding the system with stimulus. After the 2024 election, the U.S. government unleashed a stimulus package of massive scale, bigger than previous versions. It included infrastructure spending, tax credits, defense funding, and even direct payments to households. All of this pushed demand into overdrive, temporarily lifting corporate earnings and, by extension, stock prices. But here's the key. This isn't organic growth, it's artificial. Like a balloon inflated with hot air, it appears bigger, but it's fragile. If the air is removed, the illusion vanishes. Buffett has long warned that economic stimulus without long-term productivity is like eating dessert before dinner. It may feel good in the short run, but it doesn't lead to sustainable health. He's been critical of debt-driven economic expansions, particularly those that inflate asset prices without boosting real output. At the same time, the administration has reignited the trade war playbook, this time with even more aggression. Tariff threats are aimed at key partners: Canada, China, Mexico, and the European Union. Supporters say this protects American workers, but history tells a cautionary tale. The Smoot-Hawley Tariff Act of 1930, for instance, escalated a recession into a global depression. Trade froze. Global retaliation followed. U.S. exports collapsed. Today's global economy is still fragile, with supply chains reeling from the pandemic and inflation still not fully under control. Introducing new trade disruptions adds uncertainty, and markets hate uncertainty. And yet somehow the stock market keeps moving higher. Why? Because massive fiscal spending papers over the cracks. With enough stimulus, even fragile earnings look strong. But that doesn't mean the problem is gone. It just means it's temporarily hidden. Buffett isn't fooled. That's why his massive cash stockpile remains untouched. He's waiting for the moment when the fundamentals can no longer be masked. Factor 3. Pressure on the Federal Reserve, breaking the Fed. Here's where things get even more strategic. What if the current economic environment isn't just about inflation or stimulus, but about creating the conditions to force a monetary shift? Trump has made it clear he wants lower interest rates, and it's not just a preference, it's central to his economic playbook. Low rates make borrowing cheaper, boost real estate and business investment, and ease the burden of national debt. In essence, low rates are an economic accelerant. Back in his first term, Trump harshly criticized Fed Chair Jerome Powell for raising rates. He even called him an enemy at one point. Now in 2025, Powell is still in charge, and rates sit around 4.5%, kept high to manage inflation. But what happens if the economy begins to falter, or if the market stumbles? The Fed would be under enormous pressure to act. That's the plan. By creating just enough economic uncertainty through trade tension, erratic policy, and a shaky stimulus plan, the administration could create the political cover needed to force the Fed's hand. Rate cuts, even if unspoken or unofficially demanded, could be justified by economic distress. And when rates fall, what happens? Asset prices typically soar. The market gets another sugar high. But the risk is that this expansion is built on unstable ground. Again, Buffett understands this deeply. He's wary of ultra-low rates. He's called them the financial equivalent of turning off gravity. Everything floats until gravity returns. That's why he isn't deploying capital into this frenzy. He's saving it for when things crash, not rise. Factor 4. Chaos as strategy. The final piece of this puzzle may be the most controversial. What if the chaos is the point? Trump has always thrived in disruption. Whether it's foreign policy shocks, trade war escalations, or confrontations with central institutions, unpredictability is a hallmark of his strategy. That kind of chaos may seem like a liability, but it can be powerful. It creates leverage. It keeps both allies and adversaries off balance. And it generates just enough fear to justify bold, often unilateral action. Now look at the global landscape. Conflicts are flaring in Eastern Europe. The Middle East is tense, and tensions in Asia, particularly over Taiwan, are escalating. Add in unpredictable U.S. policy, and you have a recipe for global instability. Markets can't price this kind of risk effectively. They try, but volatility is inevitable. And investors, especially large ones like Buffett, know this. He's said many times that unpredictability erodes investment confidence. He prefers rules, systems, and durable businesses that can weather storms, not rely on sentiment. That's why during periods of uncertainty, he sometimes leans into defense. Historically, Berkshire Hathaway has invested in companies tied to national security, logistics, and infrastructure, not out of a desire for conflict, but as a hedge against instability. At home, political chaos can also be used as a pretext for consolidation of power. If things look like they're unraveling, it becomes easier to justify emergency measures, fast-track policy decisions, and minimize institutional checks. The worse things seem, the more attractive a strongman narrative becomes. For investors, this creates a minefield. Fragile markets might rise quickly, but they also collapse faster under pressure. And when chaos is intentional, not incidental, risk becomes systemic. Buffett sees this. That's why he's waiting. So what can you do about it? If this market really is a bubble, whether naturally occurring or manufactured, the goal isn't to outguess the timing, it's to prepare for the outcome. Start with defense. Build your financial foundation. That means an emergency fund, 3 to 6 months of expenses in a safe, accessible account. This buffer allows you to endure economic turbulence without panic.